Welcome to the week beginning the 25th of March. Now, as we look at the calendar, we've got a few significant events this week. It is a lot quieter than last week with all those central bank meetings, but it's also a good reminder why we look at the calendar and why we're looking for opportunities ahead of time. And in this short video, I'm going to explain what we've got coming up ahead on this calendar. But before we do, here's a little snapshot from last week so we can remind ourselves why we look at the calendar in the first place. The reason we look at the financial calendar in advance is to spot opportunities before they occur. Now, this is the opportunity we looked at on the 21st of March. We use our process looking at the base case, so then we can recognize the surprise and see if it changes the bigger picture. So what we were doing here was looking at the SNB rate decision. Now, we knew that the Swiss National Bank would likely have to respond to the weaker inflation prints that they've been seeing. They had targeted 1.8% for the first quarter 2024 inflation, and we knew it was around 1.1, 1.2%, depending on when you look at the core, the headline, well within the 2% target. So would they cut rates? But in their previous meeting, they saw quarter two and quarter three inflation being up at 2%. So what we're looking for today was on this day with the Swiss Met, we're looking for a rate cut of 25 basis points and inflation forecast for 2024 second quarter and third quarter that revised lower than 2%. And we were looking for Aussie Swiss franc longs. Now, this is an event that was traded live. And the analysis was done in real time. And this was the decision. And you can see here, if you look at the inflation forecast, just make this a bit obvious, the SNB cut rates, surprise, and then look at the forecast. Second quarter, you see it's down from 2% to 1.4%, and the third quarter down from 2% to 1.5%. So what it tells you, the SNB say, we see lower inflation ahead. So that means they're more likely to cut interest rates. They don't need such high interest rates. And that resulted in heavy instant Swiss franc selling. And that gave us our very clear bias that we were looking for. And if you just take a look at the dollar Swiss franc, you saw big moves higher in the dollar Swiss franc. That was expected and one opportunity we looked at. I looked at this, sold this on stop, Swiss franc Japanese yen, and I got in at 169.80 and I got out around 168.88. So I moved, around 100 points lower on that decision. And I also took an Aussie Swiss franc upside trade. We saw strong Aussie labour data out the day before and took a long on that, and then looked at the retracement entry. I took a retracement entry just around the 50% region here. That was a key opportunity as we moved into that 598.4 region, and then looking to take profit somewhere up at those highs. So that's why we look at the calendar, so we can see these high probability events before they occur and find where the edge is in the market. It's using fundamental analysis to develop that edge. So let's look at any future potential opportunities we've got coming up. A very quiet Monday, not much on the calendar there of note. Tuesday, again, a little bit quiet. So we've got some US consumer confidence data, but that's likely to be subsumed with the current narrative that the Fed is going to be cutting rates 3 times this year. Yes, GDP's ticked up a little bit higher, so too have inflation expectations. So consumer confidence shouldn't really move the market necessarily very much, not something that I'm looking at as a high probability opportunity. Australian inflation data, though, is a different matter. Last week, we saw some stronger employment data out of Australia. 116,000 jobs were added to Australia's economy. You can see that's a definite uptick in the jobs being added. And if you look at the unemployment rate, dropped to 3.7. So really a very strong labour market. And that does put the pressure on the Reserve Bank of Australia. Now, in their interest rate meeting last week, they kind of said, they can go either way on interest rate moves. So they can cut or they can hike. So they're trying to communicate a high degree of uncertainty to the market about the future path of interest rates. And if we just take a look now at the short-term interest rate markets, let me just get the right tab up, that would help. If you look here about expectations, short-term interest rate markets see 9% chance of a cut for the May meeting. And you can see that, interest rate expectations are relatively flat. They did drop a little bit out of the RBA interest meeting last week because the Reserve Bank of Australia kind of changed the wording. So they're not only having a bias now to say that they could hike rates, they're saying, we could hike, we could cut. Now, the good news for us is that means this inflation data could send the Aussie higher or lower, depending on whether we get an out of consensus print to the upside or the downside. So this is definitely one to be looking at. Nearer the time, I will update the cheat sheet with the minimum and maximum expectations when we have a better expectation of what the range of economists and analysts surveyed expectations are for the print. But it's definitely one to watch, and we potentially look to pair that with the New Zealand dollar as a typical RBA versus RBNZ rate play. So that's definitely one we'll be looking at this week. Eurozone consumer confidence, the final reading, shouldn't get too much out of that. Got EIA oil inventory data. Got some bond auctions. As long as they stay resilient and firm enough, that would be shouldn't be much of a market mover. UK GDP, a little bit more interesting. The Bank of England met again last week, and significantly what they've said is the vote changed. So at the last meeting before the one last week, there was two people who voted for a hike, Haskell and Mann. One person that voted for a cut, that was Dingra, and the other 6 were in the middle. Now, this week, markets were expecting either Haskell or Mann to move back into the unchanged pack, Dingra to remain dovish. So they're expecting a 1-7-1 split. Now, in the end, it was a more dovish split. It was a 0-8-1 split. In other words, no one at the Bank of England now thinks that the Bank of England should hike rates. 8 voted for unchanged, and only 1 wanted a vote cut. That's Dingra. She is a dovish outlier. So what that means is that, Bank of England's Bailey said on Friday last week that, rate cuts are now in play for the Bank of England. So if we got a real surprise consensus miss here, if it came in much, lower than markets were expecting, and the prior was potentially revised low as well, we could see some of that pound selling accelerate, because some of those stretched longs that we've seen in the CFTC report can further unwind. And we did see some pound selling out of the Bank of England meeting last week. So definitely one to be looking at. Going through the data, the GDP final, that's kind of old news now. That's the fourth quarter of 2023. And we know what the Fed are projecting for this year in terms of GDP. We'll look at that in a minute. Jobless claims, employment data is obviously important out of the US. You'd need something really shockingly bad to move the US. The Michigan sentiment is a good report, but it's the final report. It's the flash, or the preliminary one is the first one we want to take note of. So not expecting much out of that. Japanese CPI, again, not expecting any big surprises out of Japan, with the Bank of Japan meeting last week as well. And they're sort of slowly exiting negative interest rates. They have actually exited negative interest rates now. They are positive, but they're not going to be rapidly hiking interest rates. So it's all about the speed for the Bank of Japan at the moment. Yes, they've exited negative interest rates, but it's all about the pace, and unlikely to see any data that pushes them forward. Obviously, if this came in super hot, if this start coming in, 2.8%, 2.9% or 3% core, something like that, then that could lift the yen in anticipation of a more aggressive Bank of Japan. However, the main event we are looking for is the US PCE print. Now, this is the event of the week. And what's going to be interesting with this is the last Fed meeting, what the Fed have essentially said, and if you look at the meeting, dot plot, they said, yes, we see 3 rate cuts, just like we saw in December, right? However, we see GDP higher, right? 2.1 versus 1.4 we saw in December. And we see inflation higher, 2.6, just like above the projection we saw in 2.4. So if you look at this, and I know that the initial reaction to the Federal Reserve meeting was the dollar was sold off strongly, and the focus on those 3 rate cuts. And we were looking at this live at the time, and I said at the time, hang on guys, look, PCE has actually been revised higher, and GDP is revised higher. That's a more inflationary print. The markets ran with 3 rate cuts, and also look at the rate for 2025. It's been revised higher. Do you see? So it is a bit of a higher for longer kind of. It's a bit of a higher for longer shift there at the the longer run outlook, and you see 2.6 up from 2.5, 3.1 up from 2.9, 3 point up from 3.6. So I was saying at the time, your dollar strength would make more sense here, and GDP higher as well, and inflation higher, right? But market just happy to say, oh, 3 rate cuts, hooray, 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 rate cuts are coming. So that means this inflation print is going to be crucial. If this comes in even hotter than markets are expecting, then we could see some significant dollar strength, because markets might think, well, hang on, the Feds won't be able to cut rates so aggressively, and actually inflation's stickier, and people will start to think, well, the Fed will only cut once, and then you may well see the dollar strengthen. So at the moment, the bigger picture is the Fed's cutting 3 times this year, and so that should weaken the dollar. In the near term, this PCE print is going to be laser focus of the market, could be a great opportunity. And if it is a big miss in the data, and it does come in below market expectations and really misses lower, then we could easily see the dollar sink rapidly, and might see good upside euro US dollar, for instance. We'll choose the pairs nearer the time, but that's what we're going to be looking for this week.